what he's been recommending to do in this market. Harsha, hi, morning. Great to have you on the show. Harsha, consistent DI buying, consistent FI selling, but who's selling mid and small caps?
Good morning, Aisha. I think clearly the value worries on small caps and to a certain extent even mid caps is playing out. As we have seen over the past couple of quarters, the earnings deceleration in small cap segment has been much more than what everyone anticipated. So to that extent, yes, the valuation risk still exists in case of small caps. And in some selective mid caps as well, the valuations are on the higher side. So to that extent, whenever a market goes into a correction mode, you can imagine there will be some nervousness on some of these segments. And that's where you are seeing some amount of selling again happening.
So, Harsha, what is your sense as we step into the new calendar year? Do you think that the pressure is going to sustain on mid and small caps? Because like you said rightly, there are still pockets which are overvalued from within mid and small caps, that is. And will it continue to be large cap outperformance that we're going to see in the next year too?
Aisha, clearly the vulnerability on small caps will continue in our opinion because this is the segment which is still trading at about 40 to 45% premium to a long-term 10-year average on a historical basis. And also, if you look at earnings expectations for small caps going forward for the next couple of quarters, they are unlikely to be anything different than what we have seen for the past couple of quarters. So to that extent, yes, there is valuation risk in small caps still, despite the correction that we have seen during the calendar year 2025. However, large caps and mid caps are expected to show some bit of recovery in terms of earnings growth. It's not going to be a V-shaped recovery, but still it's going to be a decent recovery in our opinion. So to that extent, I think large and mid caps would continue to be the places to be rather than small caps.
And what within that pack, Harsha, that you seem to like within the large cap pack? Would it be IT? Would it be financials? And give us a bit of color on that.
Clearly, from a sectoral perspective, we continue to remain positive on banking and financials and consumption-oriented sectors. IT is not one of the spaces where we have very large positions or very large overweights at this point of time. Yes, there could be a pullback rally in IT as it has underperformed significantly over the last 4 or 5 quarters. And since these are the companies which don't have leverage or have decent cash flows, while the growth may be muted, but from a balance sheet perspective, there are no risks. So anytime you see volatility in the market, you will see some of these stocks actually outperforming on a relative basis. So that could happen. But otherwise, from a slightly medium to long-term perspective, we still believe that banking and financial services sector and consumption-oriented segments, of course, you need to be selective even within that as valuation may not be similar across the sector. But these are the 2 segments where we think there would be outperformance going forward.
Okay. And Harsha, with regard to IT in particular, rate cuts, what does that do in terms of demand, in your opinion? Does it come back? And also the outlook, right? While they've indicated only a 25 basis point rate cut in 2026, but just the fact that there's a new chairman who's likely going to take charge, and he is likely to be much more dovish, of course, given the stance of the president. And therefore, do you believe that the tilt towards IT may well be at play, given that they are already trading around 20% lower, especially the large caps, 20% lower versus their 5-year averages?
They will probably outperform on a sustained basis only when the business momentum comes back strongly. That we are not seeing yet across the sector. Yes, as we discussed earlier as well, valuations have come off, especially during last 12 months. So to that extent, some of the short-term triggers could lead to a bit of a rally in the very short term. However, for a sustained outperformance, you will still need to see a larger growth on the business side, which is still elusive. So to that extent, while we will have some positions in the portfolio, we are unlikely to really go very overweight on the sector at this point of time.
Harsha, it's equally important to know what to avoid in this market. Where is it that you would say steer clear, either because of the valuations or growth visibility?
Our tilt has been more towards domestic businesses. Clearly, domestic growth has been more resilient as compared to global-oriented sectors and businesses, I would say. But within domestic businesses, again, I don't think there is a pocket which is very, very attractive from a valuation perspective or very superlative in terms of growth. So I don't think you can take a very large sectoral bets at this point of time. You need to be more stock specific. The rally that you will see whenever is not going to be very uniform across sectors, I would say. There will be winners and losers, and only in specific businesses where there is some amount of steadiness in terms of earnings or improvement in terms of earnings, along with the valuation comfort, that's the place to be, rather than going very thematic or sectoral at this point of time.
Right.
Okay. And Harsha, in terms of broader markets, I know you're more bullish with regard to the larger caps, but mid and small, I'm sure that there are bottom-up opportunities available. Any sectors or themes that you're catching on to where the risk-reward looks favorable? I mean, I'm sure that it doesn't fit into your core thesis that valuations are reasonable or margin of safety is large. But even if the growth, the kind of pipeline of growth or the runway of growth is long enough, you could well see a quick re-rating. For example, value retail, right? Maybe trading at 90 times, but when you look at guidance coming from management, it could be 4-5x in terms of EPS in the next 4-5 years.
See, Harsh, only thing that one needs to remember is there are pockets where the growth is much higher than the average market earnings growth in case of mid caps. However, some of these sectors or businesses are already trading at a valuation which is much higher than their long-term average. And people are flocking into some of these segments only because there is higher growth at this point of time, right? And we have also seen a couple of those segments, for example, EMS, where the growth is still very, very strong, but we have seen a very, very sharp correction during this rally. What I'm trying to say is, just because there is growth, it doesn't mean that you can buy it at any valuation. You need to be conscious of valuations. So when you look at growth prospects and valuation together, there are not too many subsegments or sectors which are available at a reasonable valuation with growth exceeding market average earnings growth, I would say. So to that extent, I don't think you can really bet on any one pocket so aggressively at this point of time. But if markets were to correct further, and if you see valuation comfort opening up in any of the subsegments, probably you could do that. But at this point of time, I would still suggest that one needs to have a very diversified portfolio with a tilt towards large caps and mid caps, of course. And within that, it has to be more on a bottom-up stock-specific opportunities rather than going sectoral.
Within large caps, though, Harsha, outside of the banks and our IT gamut, what about consumption and especially domestic consumption? Do you think there too the discretionary trends will find some of the bottom-up ideas? I mean, as a sector, for instance.
Aisha, within discretionary consumption, there are many pockets where we have been positive. For example, automobiles have been one pocket where we have been positive. We have clearly been seeing very, very strong growth coming in the two-wheelers category. We have also seen demand improving in passenger vehicles, although we have to wait and see whether that sustains over the next couple of quarters. But there are pockets within automobiles where you can play. There are consumer durables, although the valuations may not be as comfortable as in case of automobile segments. You will see some of these names also performing well. And in fact, last year, summer was not so acute. And there is an expectation that this summer is unlikely to be as mild as what it was last year. So some of the appliances on the cooling side could see a better demand going forward. So there could be opportunities on that segment. And there are various other pockets of or subsegments where you could play a discretionary consumption plays. For example, quick commerce is another area where we think over the next couple of years, definitely you're going to see better profitability coming in, given that the industry is starting to consolidate. So yes, on the consumer's discretionary side, there are several plays that you can probably bet on. However, consumer staples is something that we are still not very, very comfortable on, given that growth has completely tapered off in that segment. And while the valuations may not have gone anywhere over the last couple of years, still compared to market valuations, the premium is still high for lack of growth there. So to that extent, we would prefer discretionary consumption plays, that too selectively, rather than consumer staples.
And with regard to, you've spoken a bit about financials and you being positive there. What within the financials pack? Would you play the good value public sector banks? Is that the way you'd play consumption? Would you play it through private sector banks, which are also at discounts to their averages? Or would it be through small finance banks or through capital marketplace and the like? How best do you position yourself?
We have kept it little diversified with bets across private banks as well as public sector banks. And we also have certain bets on NBFCs. As far as NBFCs are concerned, we are preferring NBFCs which have diversified book, which are not dependent on single vertical, because the risks could be there in certain verticals or could come up in certain verticals. But if it's a diversified book with a strong parentage, I think that's a better business model to bet on. As far as private banks and public sector banks are concerned, clearly on the asset quality side or on the growth side, there is hardly any differentiation at this point of time. The differentiation between the two segments is more on the valuation side, I would say, where public sector banks have a lot more valuation comfort vis-a-vis private sector banks. However, as you rightly mentioned, even private sector banks are trading at a valuation which is not very high. So to that extent, yes, both private sector as well as public sector banks can be there in the portfolio. As far as the capital market intermediaries are concerned, or many other smaller names are concerned, you need to be more bottom up in that segment, as some of these are trading at reasonably higher valuations. So to that extent, rather than taking a very large bet on specific names, it's better to take smaller bets and probably keep it a little more diversified in that segment.
Harsha, any specific sector funds where you would recommend perhaps a concentrated, investment?
Aisha, again, as I said, at this point of time, there are no specific sectors which are looking very different on our growth parameters or on the valuation comfort side. However, if you are an investor for 3 to 5 years, we believe that a consumption fund or a banking and financial services fund could be the way to look at. And also recently we launched a fund which looks at opportunities from rural economy. I think that's a space one needs to carefully watch out for, as per capita income in the rural economy has just crossed $2,000. We are likely to see a pickup in consumption in that segment. And also some of the short-term trends are suggesting that probably we are going to witness better consumption trends from that segment. So if you are a 3 to 5 year thematic category investor, then probably banking and financial services consumption or maybe rural opportunities could be the segments to look at.
Okay, Harsha, great speaking with you as always. Thank you so much for your time.
Thank you.